Hi there. Most taxpayers don't realize HMRC already receives your savings interest automatically. In this video, I'll explain exactly how HMRC tracks it and how your 2026 tax bill is calculated.
Here's a number that might just make you sit up and listen. Over 1.2 million people in the UK could be facing an unexpected tax bill on their savings. It's all because interest rates have gone up, which is great news for our savings pots, but it also means many of us are earning enough to owe tax for the very first time. So today, we are going to get perfectly clear on how HMRC knows about your interest and what you need to do to make sure you're not paying them a penny more than you absolutely have to.
Now, to make sure we get this absolutely right, this entire breakdown has been put together by the expert tax advisors at My Tax Accountant. These are the folks who live and breathe this stuff day in, day out, so you know you're getting top-tier, reliable guidance.
So, let's go back to that huge number, 1.2 million savers. You might be wondering, why is this happening now? Well, it's a bit of a good news, bad news story. For years, interest rates were so low that your savings probably weren't earning much. The good news is that's changed, but the bad news is, now that your nest egg is finally growing, HMRC is taking a much closer look.
Okay, so this all brings up a really big question, doesn't it? How on earth does HMRC find out what you're earning in interest from all your different accounts? And probably the more important question for you, can you just blindly trust the numbers they send you? Well, I'll give you a spoiler, you really shouldn't.
All right, here's our game plan for today. We're going to start by looking at HMRC's automatic system, how it's supposed to work, and, crucially, where it often messes up. Then we'll cover your tax-free allowances. That's the good bit that helps you keep your money. We'll pinpoint when you absolutely have to contact HMRC yourself, how to check and fix their mistakes, and we'll finish up with some smart, legal ways to save on tax. Sound good? Let's get into it.
Right, let's kick things off with this so-called automatic system. On the surface, it's designed to make life really easy for everyone, but, and believe me, it is a big but, it's got some serious flaws that you need to know about.
So here's how it's supposed to work, in theory. At the end of the tax year, your bank basically sends a message to HMRC telling them exactly how much interest you've earned. HMRC then looks at that number and takes a guess at what you'll earn in the coming year. If they think you'll owe tax, they just tweak your tax code. If you're on PAYE, the tax then comes straight out of your wages. No fuss, no forms. Sounds great, doesn't it?
Yeah, well, here's where it gets messy. That simple, automatic system, it is far from foolproof. In fact, it's pretty flawed. And those flaws could easily end up costing you real money if you're not paying attention. Okay, let's look at all the ways this can go pear-shaped. First up, estimates. HMRC is essentially guessing your future interest based on old info. But what if you moved a big chunk of money last year? Their guess will be completely wrong. Then you've got simple data errors, figures getting duplicated or put in the wrong tax year. We've even seen weird cases where interest from a tax-free ISA gets reported by mistake. And here's one that catches a lot of people out. Joint accounts. HMRC just assumes you split the interest 50-50 with the other person, which might not be true at all.
So what's the bottom line here? It's this. At the end of the day, it is your legal responsibility to make sure your tax is correct. Not HMRC's, not your bank's, yours. You simply cannot afford to just assume they've got it right.
Okay, so how do you even know if you owe tax in the first place? Well, this is where your tax-free allowances come in. Think of these as your financial superheroes. They exist to protect your cash from the taxman.
First, you've got the big one that most people know about, the personal allowance. It's £12,570. Now, most people think this is just for their salary, but here's the clever bit. If your wages don't use it all up, the leftover part can be used to cover your savings interest, completely tax-free.
On top of that, you get another one just for savings. It's called the Personal Savings Allowance, or PSA. If you're a basic rate taxpayer, that's another £1,000 of interest you can earn tax-free. If you're a higher rate taxpayer, that drops to 500 quid. And sorry to say, for additional rate taxpayers earning over 125,000, you don't get one at all. So it really pays to know which tax band you're in.
But stay with me, because you'll want to hear this next part. There's another allowance, a kind of secret one, that most people have never even heard of. And it's a real game changer for people on lower incomes.
It's called the starting rate for savings, and it's brilliant. Basically, if your other income, from a job or a pension say, is less than £17,570, you could get another $5,000 of savings interest completely tax-free. This is huge for students, retirees, or anyone not earning a big salary.
So let's just add all of that up for a second. Think about this. If you had no other income whatsoever, you could potentially earn, wait for it, £18,570 in savings interest and pay zero tax. That's your personal allowance, the starting rate, and the PSA all working together. That is a massive amount of tax-free cash.
Right, so we know the system can fail, but we also know we've got these great allowances on our side. Now we get to the really crucial bit. When do you have to stop relying on the system and actually take action and tell HMRC what's going on yourself? These are the red flags you absolutely cannot ignore.
Listen up, because there are 3 big ones. 1, if your total savings interest from all your accounts goes over £10,000 in a tax year, you have to register for self-assessment and declare it. No exceptions. 2, if you already do a tax return for any other reason, like being self-employed or a landlord, you must put all your savings interest on there, even if it's just a few quid. And 3, if any of that interest comes from an account outside of the UK.
And I really want to double down on that last point about foreign savings. Thinking that HMRC can't see an account you have abroad is a massive and frankly dangerous mistake these days. Thanks to an international agreement, over 100 countries are now automatically sharing bank data with HMRC. Seriously, they know. Assuming your money is invisible is just asking for trouble and some very serious penalties.
Okay, so what do you actually do about all this? How do you check if HMRC's figures are right? And more importantly, how do you fix things if they've got them wrong? Let's walk through a simple action plan.
It's a simple 3-step process. Step 1, dig out the paperwork from HMRC. That'll be your P2 tax code notice, or maybe a P800 tax calculation. Find the number they're using for your savings interest. Step 2, do the sums yourself. Get all your bank statements for the year and add up the interest from every single account, and I mean every account. Step 3, compare the 2 numbers. If they don't match, get on the phone to HMRC straight away and tell them their figure is wrong. Don't put it off.
And here's a little pro tip for you. If you're on the phone to HMRC and their number just doesn't make any sense, don't let them fob you off. Ask them for a full breakdown. Tell them that you want to know which bank, which account number, and exactly how much interest they think you earned from each one. They have to give you this information. And trust me, it's often the quickest way to find where the mistake is.
All right, last section. We've talked a lot about checking for mistakes, but how about we get ahead of the game? Let's talk about some really smart and perfectly legal ways to structure your savings so you pay less tax in the first place.
The number 1 weapon in your tax-saving arsenal is the ISA, the Individual Savings Account. The difference is just night and day. Interest in a regular account is potentially taxable, but interest in a cash ISA, it is always 100% tax-free. It doesn't even use up your other allowances. You can put up to £20,000 into ISAs this tax year. Honestly, for most people, it's a no-brainer.
And here's another great tip. This one is for couples. Remember how HMRC just assumes everything in a joint account is split 50-50? Well, you can actually tell them that's not the case. If you're married or in a civil partnership, you can use something called a Form 17 to declare that, say, 90% of the interest really belongs to the partner who pays a lower rate of tax. This lets you make the most of both of your allowances. It's a fantastic and often overlooked tax planning tool.
Okay, let's wrap this up with the key things to remember. 1. The automatic system is useful, but do not trust it blindly. 2. It is your job to make sure your tax is right. 3. Know your allowances, your personal, your savings, and that starting rate. 4. If your interest is over 10 grand or comes from abroad, you have to tell HMRC. And 5. Use tax-free ISAs, and, if you're a couple, plan your savings together. So, I'll leave you with this final question to think about. After everything we've covered, can you honestly say you're 100% certain that you're paying the right amount of tax on your savings, and not a penny more?
And just a quick but important disclaimer. All the information today is for general guidance and is accurate as of February 2026, but tax is complicated and the rules can change, so this isn't a substitute for professional personal advice. So if you want advice that's tailored specifically to you and your savings, your best bet is to talk to the experts. You can get in touch with my tax accountant on 0208 570 8531, or you can drop them an email at info@mytaxaccountant.co.uk. I really hope you found this useful, and if you did, please subscribe to the My Tax Accountant channel for more straightforward tax help just like this.